So equity is one of those things that people tend to be intimidated by, and it really is a simple concept. It's really just you buy a house, and especially at this day and age, it's happening a lot. You buy a house, don't murder me for my drawings. This is insurance. You buy a house for $300,000. Because of the rise of the valuation of houses or the housing market now, a lot of times before you move into that house is worth 450,000. So equity is simply the difference between what you owe and what the house is worth. So in this case, because of the increased valuation, you now have between $100,000 and $150,000 in equity. Now, why is that important? In the event that you want to make upgrades, you find yourself in a bind, want to consolidate, want to do a lower cost loan, you can essentially borrow from yourself through a home equity loan or line of credit, or by just pulling money out and doing a cash out refinance and financing it into the mortgage using your home as collateral. So that's $100,000 to $150,000 worth of cash that you have in your wall, basically, of the house. Now, the reason that's important when it comes to insurance is a lot of times people overlook the fact that insurance could be used as an instrument to protect the equity in that house, especially in Florida, where we have people retiring to the state, taking out mortgages where they have this equity in the house and they're looking at mortgage protection and they want to pay the house off. Well, paying the house off doesn't always make sense because A, because their family is still up north, or B, because it's just cost prohibitive. So in protecting the equity of the house, it's really just putting a policy in place, a smaller policy, to make payments for 3 months, 6 months, or 9 months so that that financial burden doesn't fall on or disrupt the financial stability of their loved ones, so that they can maintain that property with comfort and ease as they travel back and forth or say goodbye to you, to their loved one, and not feel the financial strain of maintaining that mortgage or fall victim to foreclosure, a short sale, a fire sale, or those things that cause them to take less for the property than it's worth because they just need to get out from under it. And this is essentially you preserving your legacy, because ensuring that they get top dollar for that house by putting a small policy in place to protect the equity of the house and maintain those payments is what we refer to still as mortgage protection, but for you make more sense as mortgage payment protection or equity protection, because as you purchase a home, which most people do so that they own it, we're really looking at a means of protecting that equity that you build in the house so that it stays with your family as opposed to going back to the bank. So there's really no need to be intimidated by equity, because it really is a simple process for you to understand, navigate, and wrap your head around. And it really is something that you can leverage and use through many stages of life, including your passing, as a means of passing on a legacy to the next generation. I hope that makes sense. And if not, clearly you're watching this here, so you know where to find me. Be well.